Alright, so in this video I want to talk about how to manage a put credit spread that is tested or breached, or a bull put spread. So there are many ways to manage a put credit spread that gets tested. From my experience, I've used 3 ways. The most mechanical way, if you don't want to make any assumptions, any opinion, is to sell a call spread against it. The other way would be to roll the put spread as is to a further expiry. And the third way would be to sell the long put of the put spread, and then you keep the short put and you just keep rolling the short put until the stock recovers. So I've tried all these 3 methods, and I'll tell you which one I prefer and how to actually do them on your trading platform. So the call spread, selling a call spread against your put spread that gets tested or breached, that's the most common way, or the most mechanical way. What it does is, the point of it is to reduce max loss. So when you enter a put spread to begin with, say you collected $1 from this put spread. So I sold the 90 put for $2. I bought the 85 put for $1. So my net credit is $1. My max loss is $4 because it's $5. The 90 minus 85 minus $1 I collected. So my max loss is $4. And it happens if the stock trades below 85 at expiry. So let's say before expiry, the stock drops below 85. So you want to take action. So the most common action to take is to sell a call spread on the other side. What that does is that it helps you collect more credit. So you collected $1 initially, and say you collect another $1 from the call spread. So now your max loss, instead of being $4, is now only $3. But you also give a chance for the stock to maybe recover and come back up between this profit range of 90 and 110. And say the stock continues to drop, well, then you bring your call spread lower. You close the call spread that you open and you bring it closer, collecting more credit, therefore reducing your max loss. So this is like accepting that the trade will be a loser, but you're trying to reduce max loss, and you're giving the trade a chance to win at the same time. You want to bring your call spread closer and closer up to the same short strike as the 90. You don't want your call spread to go below 85, because then you could be losing on both sides. But in this case, you cannot lose on both sides. So if my call spread's at 110 and my put spread is at 90, I'm either going to lose on the put side or I'm going to lose on the call side. I can't lose on both sides. So that's why I'm actually reducing max loss, because I'm collecting extra credit, but my max loss is still the same. The max I'll pay to close this whole trade, which becomes an iron condor now, will be $5. And since I collected credit from the put side and I collected credit from the call side, well, then I'm reducing my potential loss. So let's look at an example with Questrade. So for example, I've got this put spread on already on VMware for December 18 expiry at a 140 strike, 135. And it's not breached, but it is definitely tested. So what I could do is I could start selling call spreads against it to reduce max loss. So initially I collected a $1 credit from this put spread. So say I wanted to let's say I wanted to sell a call spread to collect more credit. Well, I simply bring up the trade by clicking create order over here. It brings it up in the order entry window here. And then there's many ways to do it, but I just like to bring it up and then just switch it to call spread, and then click sell. And then the 140, let's say I want to sell the 150. So therefore I'll collect extra credit, and I also give the trade a chance to come back up and become a winner. So 150, and I want to keep the same width of the spread. So I had a 5-point wide spread, so I want a 5-point wide call spread as well. So let's see how much credit that gives me. So as you can see, that doesn't give me enough credit because we're going to December 18 and it's next week. So what I'll have to do if I want to collect more credit is I might have to go all the way down to 140, which is the same strike as the put. Therefore, I'm turning the trade into an iron butterfly. And let's see how much credit I get. In this case, I would collect about $1.80 maybe, $1.70. So it's pretty good. So now I reduce my max loss to the difference of $5 minus the $1 collected from the put side, and $1.80, for example, collected from the call spread. But I also add a restriction to my trade to become a winner. Now the stock really needs to stay around 140 at expiry for me to win on this trade. If it goes above 145 or goes below 135, I incur max loss. So that's the trade-off. So let's say I do 145 instead. Let's say I sell the 145 and buy the 150 call spread. Then I collect maybe 50 cents, 40 cents. So I'm collecting less credit, but I have a wider room for the trade to win, because now VMware would have to close between 140 and 145 instead. So that's one way of managing a put spread that is tested. So another way of managing a put spread that's tested or breached is to roll the put spread. So let's say I have this put spread here, 90.85, it gets tested. If I roll it before the short strike gets breached, I can actually roll it for a credit. So I keep the same strikes, but I change the expiry, I can roll it for a credit. In fact, I could even sometimes roll it down. So I could bring the strikes down and roll it for a credit if I roll it before it gets breached. But once it gets breached, it becomes harder to roll for a credit. You will have to roll for a debit. But maybe you just want to give more time to the trade, knowing that if you have more time, the trade will become a winner. So let's say you collected $1, maybe you accept to roll it forward, same strikes, but this time you pay $1, so now it's break even. Now you've collected nothing, and you're just trying to save the trade. It's a little risky because if the stock doesn't come back up, then you're actually adding to your losses. So ideally, you want to roll for a credit or roll down for a debit. If you're going to roll for a debit, then at least roll it down to make the trade safer and have a better chance to win. But it becomes tricky because you have to decide before it gets breached. So if it's getting close to being tested, you have to decide, do I keep it and maybe I'll win? Or do I extend duration on the trade? But then I'm holding the trade longer, and who knows, if you hold the trade longer, maybe it keeps going down and you're adding more time risk to the trade because anything can happen. So that's a decision you have to make if you want to roll or hold on to the trade. So let's look at an example with Questrade. So let's look at this example, the same one, VMware, December 18. So let me click create order on the put spread that I have that is tested, not breached, but tested. So let's say I want to give it more time because I'm worried I've got 1 week to go and I'm very close to my short strike. So I want to give it more time. Let's say I want to go to January. So all I will do is click on the customize button and then click add put, and then I'll choose the put that I want to sell. So let's say January. I'm going to choose the same strike, so 140, and then I'm going to click add put again. And I choose my expiry of January 15, and I'm going to choose the same strike, so 140, 135. As you can see, I could roll this exact put spread, same strikes for January 15, and I can do it for a credit. So about maybe 40 cents, so $1.30 minus 40, 90 divided by 2, so about 40 cents. Now let's see if I can bring it down. Let's see if I can roll the strikes down. So if I roll the strikes down, keeping the same width of the spread, I can still do it for a credit. This one's probably going to be closer to break even. So as you can see, I can make the put spread safer, go to January 15, and I could do it for maybe 10 cents or less. So I'm not losing money. I'm just making the trade safer and rolling it for a small credit. Let's see if I try to roll it to 135, 130, probably won't be able to do it for a credit. As you can see, I'll have to do it for a debit. And let's say I go further out. Let's say I go to January 22nd. Does that help? So I'll still have to roll it for a debit. So here's a trade that I actually want to roll live with you. So this is an earnings trade on Adobe. I entered this trade this morning, but I didn't get the best entry, and I don't like that I'm only 12 points away from my short strike going into earnings. So I'm going to roll it. I'm going to give it more time. So here's what I'm going to do. And then I'm going to open a new one for this week a bit lower. So I'm going to click create order over here, opens the order entry window here. Going to click customize. I'm going to add put. I'm going to click sell. I'm going to go to January 15. And then first of all, I'm going to start off by using the same strikes, but I know I can actually bring the strikes lower. But let's just start off by using the same strikes. Then I'm going to click add put. Now I'm doing this because it hasn't been breached yet. So that I'm able to do that because it hasn't been breached. January 15, I'm going to buy the 465 put. So the exact same strikes. And as you can see, I could do that for actually break even. That's not good. I should be able to do this for a credit, but it shows that I can do it for break even. So let's see if obviously if I bring the strikes lower, it's not going to work. I just want to try something, 460, 455. So that's what's great about Questrade, is that it's easy to change your strikes and expiries and try different strikes just to see what kind of credit you can get. So as you can see here, I'd be getting a debit. I'd have to pay a debit to roll it down to 460. So I'm not going to do that unless I do that and accept to pay the $1 credit that I received to open the trade. I pay $1 to roll it down, and now I'm at break even. But I'd rather roll for a credit right now because it's not even breached yet. It's getting too close to I was supposed to be 20 points away on this spread before earnings, and now I'm only 13 points away because the stock dropped after I placed my entry. So let's say I go to February. Let's try February. Let's see what happens if I go to February. So with a 460, 455, and I could actually do it for break even. And let's say I go to 465 instead and 4 460. I could do it for a small credit. So you know what? I think that's what I'm gonna do. So I'm gonna close this one, roll it to February for a small credit, and I bring the strikes lower. Actually, let me try December 18. Let's see what happens if I just roll it 1 week. I could do it for a small debit. And if I keep the same exact strike, so 470, 465, I could also, I would do it for break even. Seems like the option prices are not liquid, so there's always a big difference between the bid and spread, although it's not that bid and ask, although it's not that big. Anyways, so let me go back to February just to give myself more time for the trade to become a winner. So let's go to February. See, if I do the 470, 465, I'll collect the credit, but I want the trade to be safer. Let's go 460, 455. I'm trying to keep the same width of the spread, so I could do it for break even on this one. So let's try this. I'm gonna put 0. I'm trying to roll it for break even. I don't think it's gonna get filled. I'll adjust later. Actually, let me do it. Let me change it to 465, 460, because I want it to get filled right away. So I'm bringing down the 470, 465 to 465, 460, but I'm going to February, and I'm gonna put 0 here. Click send order. So buy to close, sell to close my existing put spread, and I'm gonna open a new one, sell to open, buy to open, 465, 460 for February. All right, send order. So it got filled, and it actually got filled for 39 cents. Okay, so I collected a credit of 39 cents, and I moved my strikes lower, and I went to February. But I'm only able to do that because I'm catching it before it gets breached. Once it's breached, I'm gonna have to roll for a debit. So now what I'm gonna go do is I'm gonna sell another one for this week. I'm gonna try to get a better entry for this week. I like to play earnings for the same week expiry. So as you can see, expected move is about 25. So 483 minus 25 is about 458. So I'm gonna go with a 460 put spread for this week. So as you can see, it's a much better entry than my 470. So 460, 455. And as you can see, I can collect over $1. Let's see if I do 455, 450. Yeah, not enough. What about 457.5 and 452.5? Can almost collect $1 on this one. Maybe I should try this one. No, I'm gonna keep it 460. Let's keep it 460, 455. And yeah, let's put in $1. So sell to open 460, buy to open 455 for December 11 expiry, send order. So it got filled at $1.07. So now I've got a new put spread on Adobe for this week with a better entry than the one I had initially at 470. And the one that I had at 470, I rolled it to February for 465. So let's say Adobe drops after earnings, then I have time for this one to recover. This one's might be in trouble, but at least I gave myself enough room compared to the first one. If Adobe goes up after earnings, then I'll be able to close this one for sure. This one, I might be able to close it. It depends if Adobe goes up high enough. Otherwise, I'm just gonna have to wait a little bit before I can close it. And I wanted to do the same thing with RH. I don't think I got the best entry. So I got my entries at 425, 420, collected $1. And as you can see right now, it's already trading for $1.50, about $1.60. RH is at 466. So let's see if I wanted to do a new put spread on it. So 465, it's about 50 points. So I should be at around 415 instead of being at around 425. So let's see what the 415 can get me. I meant to do a vertical. So the 415 put spread gets me about 415. Oh, there's 8 minutes left to the market. So 415, 410 gets me about 90 cents. So if I were to do a new put spread, I'd probably go to the 420, 415. Oh, that allows me to get a lot. That's a big difference. See, I would get about $1.50. If I do the 415, 410, I'd get 80 cents maybe. 417 and 412, I would get the $1 that I'm looking for. So basically, I would change my 425, 420 put spread to 417, 412. I'm just trying to think if it's worth it. So let's see if I wanted to roll this one. So I click customize, click put. Let's say I want to roll to January 15. And I want to bring this, oh no, January has only 10 point wide. I want 5 point wide. So I'm going to go to January 8th, I guess. And let's say I go to 4, let's start off with the same strikes and then adjust afterwards. So January 8th and same strikes, so 420 and 425. So for that, I can I can roll for a very small credit. Let's say I wanted to go to 420 and 415. I could still roll for a very small credit. So I could do that to give the trade more chance to win. Let's say 415, 410. I could probably do this one for break even. So I could do this trade, and then I'm basically rolling it to January 8th, giving the trade more time and bringing the strikes lower. And then I could go ahead and do another RH put spread for this week, but I'll bring it to maybe 417, 412 strikes to make it a bit safer for this week. So if I put 0, click send order, buy to close, sell to close to this week's expiry, and then I'm selling to open 415 January 8th, buy to open January 8th 410. Let's see what happens if I click send order, if it gets filled or not. So it got filled for 6-cent credit. Now I'm going to send a new one for this week, making it a bit safer. And I think I already said I was going to go for the 412. So go to the 417.50 and 412.50 just to make the trade for this week a bit safer. And I can collect $1, put $1 in, send order. So sell to open RH December 11 417.5, buy to open December 11 412.5, asking for $1, and it got filled for $1.04. So that's how I would roll a put spread before it gets tested or breached. And all depending on it, how close you are to being tested, and if you're breached, the credit received will be different. But you can always adjust the strikes and even the date that you want to roll to. So here's an interesting one. This is a put spread I've got on NVIDIA. It's 10 point wide. This was actually rolled previously. So say I want to roll it to January, but I want to make it 5 point wide. So I can actually go from 10 points to 5 points. And here's how you could do it. So if I add put and then pick January 15, for example, and let's say sell the 480 strike, and then add another put and then pick the same expiry, January 15, and then sell the 475. So you could see that I can actually do it for a credit. So I brought the width of the spread lower, and I just added more time to the trade, and I can actually roll it for a credit. And let's see if I try to bring it lower. Let's say I do 475, 470. Yeah, in this case, it'll be for a debit. So if I keep the same short strike of 480, but then lower the width of the spread from 470 to 475, I can actually do it for a small credit, and that's because I'm doing it before it gets breached. But once it's tested, it becomes very hard to roll for a credit. So if we want to simulate a put spread that's already tested and how much we can roll for a credit, let's just say I've got the December 18 on NVIDIA, but I've got it at, let's say, 520 and 515. So this is just a simulation to see how can you roll a put spread that's already tested. So I've got the 520, 515, and let's say I wanted to roll it to January. Then if I do the exact same strikes, 520 and 515, as you can see, it's going to be for a debit of about $1, maybe a little bit less, maybe 60 cents. So what that does is I'm adding more time to the trade, but I'm adding more risk to the trade because I paid a debit to roll the put spread. And even if I add more time, it's always going to be a debit because I have to buy that long put, which has value, which becomes more expensive as well. So I'm always going to be rolling for a debit, even if I add more time to the trade, if my put spread is breached. Now, the other way of rolling a put spread or managing a put spread that gets tested or breached, I think once a put spread is breached, probably selling the long put might be the best option if you have the capital for it. So once your put spread is breached, the long put is now worth more. So you can sell it to receive a credit. Then you're left with the short put. Then you can easily roll the short put for a credit until stock eventually recovers. So if you have enough capital, this could be a good trade. I did this on EA Sports or Electronic Arts. So I have a video explaining this trade. So I'll just link it below, go watch it. But basically what I do is if I can afford to roll the naked put, if I have enough capital to roll the naked put, because a naked put takes more capital than a spread. The capital required for a spread is basically the width of the spread. But the capital required for a naked put, it depends on the price of the underlying and how in the money or out of the money you are. So let's take the example of BABA here. So I've got the 255, 250. So let's say I got breached on BABA. What I would do is I would sell my long put. So my long put in this case is 250. I would sell it, collect $11. So that's $1,100. And then I'm left with a 255 naked put that I can easily roll for a credit. Because naked puts, you can always roll for a credit if you're at the same strike, and then basically you're waiting for the stock to recover. So that would be the third option in terms of managing a put spread. All right, so if you have any questions, leave them in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral link to get $50 in free trades. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.